One thing we want to do when we look at Europe is we want to kick off looking at the Eurozone aggregate and try to understand how things are getting better, how is it happening as a union. So when we look at the Eurozone composite, it expected at 54.3, came in at 54.2. Eurozone services was expected at 54.7, came in at 54.6. So very much in line, nothing crazy, which is kind of where we were sitting on the services side. Manufacturing was the one that saw some of that hiccup. We'll talk about that more in a minute. But the PPI shifted up again, and we saw it, and again, this is for September, so we know October is going to be worse. When you look, the expectation was for 2.3%, came in at 2.7, and then the PPI was expected at 15.4, came in at 16. Retail sales weakened a bit in September, but investor sentiment's getting better. Survey expectations are getting better. Investor confidence was expected at 15, came in at 18.3. The ZEW survey expectations came in at 25.9, an improvement from last month of 21. So you're starting to see some of this mix back and forth. It's just going to be a matter of who benefits the most and where, and that's what we want to go through. So European sector PMI business activity, when you look at just kind of where things sit, autos and automobiles, a flat line, those should get a bit better. Metals and mining remain soft, but again, that technology equipment still is going to bump along at the highs, just given the demand and just given the issues broadly. They're going to have to pull more from the local segment, the local area, which will help support that activity. But when we look at things overall and talk about Euro area core CPI, trimmed mean CPI, you get an idea of just where that gap is and why that trimmed. So when you look at the U.S., the trimmed CPI lagged. It wasn't going up, and then it started to really get pulled up as we said it was going to. But there's still that large gap in the euro area, and that's going to close, and that we're going to see that get pulled up as that mean CPI gets. And again, just because we were a bit earlier to this, and they're just going to start to see this accelerate and come down that level, while slack remains in the labor market. It still remains an underlying problem. It's still elevated. There's still that issue in terms of the labor market where it was getting better. Obviously, the pandemic happens, and now it's improved, but still not to the level that they need, which is going to become a bigger issue when you look at inflation and trying to pass and trying to move that through the system. But when you look at the fiscal illusion, and this is something that the IIF has been very good at pointing out. When you look at who's buying what, the Bank of Italy has been the biggest buyer of the Italian government bonds. And as that goes away, as that essentially disappears, and then the same happened in Spain. The Bank of Spain has been the biggest buyer. Well, what happens when that stops, when that slows because they can't pass it off to the ECB? And we're going to find out. And the answer is rates are going to go up because you're going to lose literally your only buyer of any meaningful size for the last several quarters. But even with that, the investor confidence came up. It's still off the highs, but again, this rebound is there, and you have some things that are getting a bit more positive, and that's providing some of that uplift. All the while, you're getting slower trade with the U.S., which I don't think is out of question, especially when you think about where pressures are, where prices are, how this is starting to normalize. You're going to start to see this get clamped down and, again, put pressure on exports, and that will not so much, that'll just cap how much European growth there can be, just because you're already seeing it from China, you're seeing it now from the US, and that's going to, again, be an overall headwind to where that European growth can really reside. Now, when we look at Germany and the big increase in just economic data. So factory orders came down a bit in September, which we knew. That gets a bit better in October. So the services in October was expected at 52.4, came in at 52.4. German composite was expected at 52, came in at 52. Industrial production was expected at 1%, came in at negative 1.1%. All of that was fairly known. That has gotten a little bit better in October, but German construction is still contracting. It was previous month was 47.1. October was 47.7, a little bit better, but again, that overarching issue remains. With exports were expected to be at flat. They came in at negative 0.7%. Imports were expected at 0.5, came in at 0.1. Current account balance, again, was expected at 17 billion euro, came in at 19.6. So you're seeing that slowdown in trade, and that's something that we think accelerates. Imports were slightly better than exports, so you should see some bouncing. But again, this is why we see the pressure we see in Germany, is because it's an exporting nation, and they're just not able to achieve that, given pricing, given global weakness, which again is the overarching problem. Survey expectations for November were expected at 20, came in at 31.7. Survey current situation was expected at 18.3, came in at 12.5. So people are still expecting it to get better, but currently things are still a struggle. Now, that should change as COVID continues to be a problem in Germany. We're seeing more COVID cases. You're starting to get some calls for provincial or local lockdowns, or at least limitations, which again is just going to hinder activity as CPI continues to trend higher. Expectation was for 0.5, came in at 0.5. Year over year was expected at 4.5%, came in at 4.5%. So still seeing that acceleration up. Now, when we look at market Eurozone services PMI, again, the survey was for 54.7. So you're just seeing it normalize. Again, still expanding. Some of the reasons why it's expanding are negative in terms of pricing and delays, but it's still, once you even back those out, it's still expansionary. It's still positive growth, just not robust growth, just growth. And then you get factor in the fiscal drag and all the other issues, and that becomes a bigger problem. Where when we look at German retail sales, starting to come down a bit. France remains elevated as Spain and Italy, especially Italy, continues to recover. Italy's the one that, again, we've talked about being the bright spot in the situation. And then this is just showing the German expectations of economic growth. Survey was for 20, came in at 31.7. Still down, still weak, but off the lows as things start to improve as we go into the end of the year. German exports falling below the trend. That's something that we expect to continue and trend closer and further away from their previous norm. When you look at 17, 18, 19, 20, we expect it to weaken a touch as German industrial production has stalled amid geopolitical tensions, transport bottlenecks, and a shift to green energy. I don't see that changing, which is why those exports are going to come down as industrial production index from manufacturing weakens. German factory orders, again, flattish, pointing to a bit more problems as industrial production continues to come down, as we continue to see that weakness, construction showing it. Again, this is what is leading to our concern for German growth, for those exports, and then really where is that recovery going to shake out, and how strong is that recovery really going to be? And that's why when you look at the German composite PMI output index, it's continuing to move closer to 50 and just putting more pressure on where that growth is and where that GDP is going to shake out. And here's where you look at the production now falling outside of the auto sector, which is the underlying problem, because the motor vehicle side is kind of flatlined and it should actually start to creep up, but production is falling elsewhere as those exports weaken, as other things outside of just motor vehicles starts to become a problem. That's going to be the underlying issue that we're going to see as we go through the remainder of this year. And then truck toll index has gotten better, so German industrial output should improve. That's something that we've been saying is it's not going to come back to massive growth, but it's just going to come off the lows. There's still supply chain issues. There's still delays for tolls, for trucking, for just moving stuff about. So that's again going to be a benefit. It's going to be better. It just won't be as good as expected. Again, keeping some of that overhang intact. So now when we look at France is, again, as we've been saying, essentially flatlining, like just doing what it's, right along estimates. So service PMI was expected at 56.6, came in at 56.6. France composite was expected at 54.7, came in at 54.7. Private payrolls right around there. Industrial production missed a bit to the downside in September, but we know it got better in October. Wages missed in Q3, should get a bit better in Q4. And again, trade balance is getting a little bit better, but you're just seeing, again, just kind of bumping along the bottom with nothing really exciting one way or the other, as France tries to awaken from that slumber. But industrial production has continuously since 2018 moved in the wrong direction, and we just don't see that stopping. It'll flatline. We don't see it going down much more, but we also don't see it recovering back to where it was in the beginning of 2019, which because there's a lot of pressure on the economy outside of just COVID, which is really that hindrance that we've talked about. And then when you look at France industrial production and intermediate goods, then you look at capital goods, month over month, consumer goods, you're seeing some of that pressure in September. But again, some of that got better in October, just not back to where it should be. As business activity rises at the quickest pace in 3 months, demand conditions improve, jobs growth is at a 20-month high, but input cost inflation at the strongest in over 13 years. That is the kind of that linchpin, because you're not seeing wages go up all that much. You're still seeing slack in labor, but you're still seeing this pressure on inflation, which again is going to impact and limit what that recovery looks like. Italy, when you look at services, expected at 54.5, surprised to the downside at 52.4. Italy composite was expected at 55.6, came in at 54.2 because manufacturing was so good. But then retail sales got better in September, strengthened a bit more in October, so should see that get better. And again, seeing with the industrial production for September was expected at negative 0.1, came in at 0.1. Industrial year-over-year growth came in at 4.4%. And then when we look at Spain got a bit better on the service side. It was expected at 55.8, came in at 56.6. Composite was expected at 56, came in at 56.2. And there's just that mismatch between inflation and growth that is hindering Spain, as they also sit on the problems that remain with their exposure to Turkey. And just looking at the Italy service side, so business activity rises at weakest rate in current 6-month sequence. Growth of new business slows but remains solid, and pace of job creation picks up amid stronger capacity pressures. Now, Italy came out of the gate hot, so we expected some normalcy, but we do see some reacceleration in Italy that we don't see in Germany. And it's a mixture, because Germany will see a little bit better manufacturing, but a little bit weaker services. The manufacturing will be better because of automobiles, but weaker because of other. But because of the size of the auto industry in Germany, a tick up is hard to offset. So again, that's where we're going to see some of that benefit as Italy kind of normalizes and then sits around right with France. So there's kind of a mixed bag. Europe, Italy still remains the favored play. There's opportunity there. Spain, obviously the least favored, and Germany the one facing the most headwinds. So now that we've covered Europe a bit, we want to go deeper into Asia and most importantly China. Now that we have some news on China Evergrande, what does that mean, and what do we expect to happen going forward?